Will we be proven right or wrong? All the marbles, right?
All the marbles, all of them. All the eggs in the basket.
Any other cliches?
Everything.
Let's throw them all out.
Don't count your money at the table. I don't know. So
Marcus backs against the wall.
Climbing a wall of worry.
Take it one day at a time.
Big week. The biggest week, and I think we say that almost every time we have a week like this, but this really is a really big week. I think there's a couple things that are absolutely perilous to watch. And the first thing is what Jerome Powell says, and I say this all the time, I'm going to repeat it here. The most dangerous time to trade is between 2 and 2:30 p.m. on Fed Day. The market reacts initially to the data, then he starts talking and tells it what to really react to, and it changes course usually. Now, remember, what's going to happen this time is we're probably going to hear a similar message from him. Rates are going to stay high. Inflation is still a problem. But I think what we're going to start hearing from him is much more of a focus on the labor market. And then we're going to get a big jobs report on Friday. If that jobs report is strong, the market is not going to like it.
All right. So, Joe, Wolf, by the way, whom I quote, their firm, they've been negative, right, throughout. They say, we continue to believe this will prove to be just another bear market rally. And they say earnings support their case. 143 S&P 500 companies reported already. The aggregate EPS surprise is running at its lowest level since the financial crisis. Guidance is on track to be the weakest it's been since 2011. And the post-report price action has been almost non-existent. They say Powell's going to be hawkish. Watch out.
If you had to place a percentage on the number of individuals that have come on this network in the last 60 days and said, on January 1st, I want you to have concentrated exposure towards high beta, what do you think that percentage would be? Because I think it would be less than 10%. And I think that's exactly what's going on in the market right now. So you're asking me if it's a bear market bounce. It's a bear market bounce for high beta. For high beta, it is a bear market bounce. As far as a sustained recovery, it's a sustained recovery for the areas of the market that are blue chip, for areas of the market that are showing the profitability and the resilience. Those areas of the market, I'll acknowledge, they're not working right now. It's where I'm allocated towards. So I'm underperforming the market right now. But I do not believe that this is the time or the moment, based on what Liz is describing, that Chairman Powell and the Federal Reserve are going to have to present to the market, the hawkishness in particular at that press conference. I just don't think you want to make that pivot towards high beta strategies.
Well, I mean, the positive case in the market has been a little bit better and easier to make of late. The question is it legit? Because the internals have been pretty good. I mean, they've been better, right? The advanced decline line highest since September, larger number than 52-week highs than lows. A lot of that has to do with the calendar and when we obviously topped out last year. Growth and value doing fairly decent. And 66% of S&P 500 stocks are above their 200-day moving average. That according to Piper Sandler. Can you make a more positive case? And if you believe we can, is it legit? Is it legit?
A positive case would be made if you anticipate that the Fed is going to ease off the gas. I mean, from the perspective of what Liz and Joe have just talked about, the Fed has given no indication, and there is a narrative that's coming through in a lot of pieces that I'm reading from some strategists, that the Fed is going to pivot away from their focus on employment. That I don't see any rationale for that. I don't see any credibility to that view, because in their mind, the only way that they're able to anchor us to the target rate of inflation that they're looking for is for us to have more weakness in the labor market. I hear the outcry from tech companies, look at what you're doing from an employment perspective. We don't need to lose these jobs. We can just stand firm here. But then there would be an acceleration, to Joe's point, back into high beta. We'd start to see some of the speculation, some of the speculative behavior coming back into the market. And so when I look at this next week, the only thing that could really support the rally, I think, over the next couple of weeks to persist would be a clear indication from the Fed that they feel that they've made massive strides in terms of getting inflation under control. And just from an absolute perspective, it's really hard to make that argument when we have so much hiring continuing, the jobs market being as strong as it is, and wage growth still not contained. We're continuing to see sizable wage growth gains that are well above the rate of inflation that the Fed is targeted.
See, Jeremy Siegel was on with me in overtime, and he still thinks you can do 15% in the market this year in the S&P, but he also thinks the Fed's going to pivot and actually cut rates in this calendar year.